Jobless claims tick up, but the US labour market remains tight. Welcome to Trading at Noon. I'm Ramzan Karmali. First to those weekly jobless claims numbers. Initial claims for state unemployment benefits ticked higher to 198,000, while separately, final GDP for the fourth quarter of 2022 has landed at an annualised growth rate of 2.6%, slightly lower than the preliminary number of 2.7%. Markets will next focus on inflation data out tomorrow, the PCE price index, which is the Fed's preferred measure of inflation. The yield on the 2-year is at a one-week high on confidence the worst of the banking crisis might be over. US Treasury Secretary Janet Yellen says US bank rules may be too loose and need re-examination. In remarks prepared for delivery to the National Association for Business Economics, Yellen also called for stronger regulation of the growing non-bank or shadow bank sector. Let's take a look at how markets stand. US equity indexes are on the rise as fears of a banking crisis ease, while investors' focus will turn to that key inflation data on Friday to get clues on what the Federal Reserve might do next. Rate-sensitive real estate stocks and tech stocks are leading the gains. Well, let's take a look at some of the movers in today's trading session. Ford share price was higher after it signed a $4.5 billion deal for a new nickel plant in Indonesia. It hopes the deal will mean cutting the price of raw materials used in the production of EV batteries. Department stores Kohl's rose after its CEO bought over $2 million worth of shares in the company. US-listed shares of JD.com, China's largest online retailer, surged after it said it plans to sell its real estate infrastructure arm. And the US-listed shares of Alibaba are on the rise again after it was reported that its logistics arm has started preparations with banks for its Hong Kong IPO. Well, to help us analyse where the US economy is, I'm joined by Shana Sissel, founder and president of Banríon Capital Management. Shana, thanks so much for joining us. I know that you think a US recession is inevitable. Why are you so confident about that?
I think because the Federal Reserve had said that they would continue to remain aggressive and raise rates until something broke. Well, something broke, but that hasn't stopped them from continuing to raise rates because they're very focused on that 2% inflation number. We are at 6. We have a long way to go. So that means that they're going to have to continue to raise rates. And there is zero probability, in my opinion, that they are going to cut rates within the next 12 months. So that means that we're going to continue to see economic growth slow. We're going to continue to see difficult economic conditions and headwinds to growth, which inevitably means a recession is in our future. Now, how serious that recession is really the question.
Can we get into a bit more detail on what you think the Fed will do next? So, the markets are 50-50 on what's going to happen in May, but what do you see after that?
Well, I believe that they'll continue to raise rates. We'll see another rate hike in May. I would not be surprised if there was a rate hike on the table after that as well. They keep saying their target is about 5.75% to 6%, and that's going to require more than one more rate hike. So I think that that's very probable. It's really going to depend on what the data shows between now and June, July.
In your notes you sent me earlier, you also said that the Fed's doing something called sneaky QE. Can you just explain what that is and why you think that's happening?
Yes. So the Federal Reserve increased the Fed window for banks to allow them to be able to access liquidity, since what we saw with Silicon Valley Bank, Signature Bank, and to some extent First Republic was a liquidity issue, not a solvency issue. Now, most of these banks had an asset liability mismatch, but it was all treasury related. So the Fed opened their window. They've made it easier for banks to sell back their treasuries at par. And that is putting liquidity back into the system. And that is inevitably what QE is. So that's sneaky QE, in my opinion. They are putting more liquidity back into the system.
So if you want to avoid all the turmoil that we've seen in the banking sector, where would you advise investors to look?
So I continue to be a big fan of liquid alternatives. You've had me on before, and I've talked about this. Liquid alternatives are low correlation to traditional equity and fixed income. They tend to do well in highly volatile environments, which is the kind of environment I think we are in and we will continue to be in. So those are things like equity market neutral. One of my favorite ETFs is BTAL. something like a risk managed hedged equity like MRSK. And there's some other opportunities like a managed futures like an FMF. So there's a lot of opportunity there. And those are where I'd be putting assets right now to be able to ride out the volatility of the market going forward.
Shana Sissel from Banríon Capital Management, many thanks for your time. Now let's turn to oil